Well, I was expecting a bit more, number of hands going up when Aditya asked about how many of you have invested recently in an IPO. Because, quite frankly, 2024 is a great year to talk about the Indian stock market story. If you read the newspaper this morning, the front headline on the Economic Times says that after 15 years, September has the most number of listings planned in a single month. You look at the stats. The year till now, 2024, about 56 companies have raised more than 65,000 crores through IPO route, compared to just 20 companies raising about 15,000 crore in the whole calendar year last year. And there may be liquidity, higher secondary market valuations, but at the heart of this, it is the retail market, retail investors. I mean, they have weathered every storm. You look at any macroeconomic trigger in the last 4 to 6 months, be it the general elections, US recessionary risks, the yen carry trade, the RBI governor subtly giving hints that every money is going into mutual funds, the budget increasing capital gains taxation, right? Then of course recently the Hindenburg saga actually revealed the nationalistic side of retail investors कि हम देखते हैं market कैसे गिरेगी जब Monday को खुलेगी, right? So, and if you look at the IPOs recently, and especially new age startups, main board, leave alone the main board, look at what's happening in the SME IPO board. You, I'm sure, have heard about that Yamaha dealership going, public recently. Then just yesterday, a packaging company, and how, a minimal setup do they have, and the oversubscription rate they have. So there's clearly a euphoria, Sidhant, Salilji, and in this backdrop, when we are looking at the financialization of the Indian markets and Indian startups jumping this bandwagon, how would you describe this financialization? And for startups today, is this the final tick mark when it comes to validation or sign of success? Sidhant, if you would like to start.
See, I mean, public markets have been going around for like many, many years, right? And I think last 3 years, 4 years, there was a huge suddenly spike in, VC funding and all those things that we've been seeing over the 4 or 5 years. But essentially, I mean, the only major way to raise money for the last 30, 40, 50 years for the whole world has been through public markets. And if it has been done very effectively, right? And I think, I wouldn't say it's the last leg. I think it's beginning of a new era for a lot of businesses, because at the end of the day, if you do benchmarking for a company, the only way to run is that you bootstrap first, or you raise a little bit of external funding, and then from an investor's point of view, investor view, maybe that's the last way of liquidation, or probably a liquidation event for them. But for companies, I think it's just the beginning. I feel that's where the true business acumen or sense comes into play, because now after that point, you're actually not just working for yourself, you're working for the country, people who are investing in you. You have part owners in the form of like hundreds and thousands of people, probably who are investing in you. And I think for us as companies who are building out and, probably eyeing an IPO, we feel that now is the time, because people are actually getting very educated now. I mean, we used to hear there were a lot of studies which said, right, the equity market in India is still so small if you compare it to the Western world, even though it's growing rapidly, and we've seen it's massively grown over the last 3 to 4 years. But still huge potential, a lot of newer audiences, newer people who are kind of entering, are looking at equity markets as a very good investment form, because it has given the highest returns over the last few years, right? And for us brands, what happens is the moment you actually think public markets, your discipline becomes a lot better in terms of operating businesses. You think of businesses from a different lens. We've seen what the COVID wave did, right? When there was so much VC funding, private equity funding happening, that discipline was somehow was a little bit lost. Brands were actually focusing on the matrices that were being looked upon by these VCs, right, by these private equity players. So I think that's changing. That's why, hence, you've seen over the last 2 to 3 years, there's been a little bit of democratization where uh, mm, businesses are looked at in a very different lens. People are not just looking at growth, they're looking at bottom line, they're looking at how will the company sustain in the public lens, in the public view 5 years later, 10 years later. So,
Sure. The interesting part of this conversation is the composition of this panel. Sidhant represents that community for whom we are having this panel. And Salil Kapoor ji, he has a vast experience of heading public listed companies in various positions. He's been part of Dish TV, Voltas, most recently Hindware. So Salil ji, I want to understand your thoughts on what really changes for startups, when it comes to their journey from being in the unlisted space to the listed space. What really changes when it comes to culture? What really takes, to maintain those investor relations? If you could shed some light on that.
If we have seen, if you pick up the history of how valuation in the startup world has evolved over the years, the long phase and the initial phase was all based on the valuations coming from your fundraise, at what value you have raised the fund. And what happened is that many times the fundraise was not dependent on the fundamentals, it was more dependent on the FOMO concept, which is fear of missing out. So if you are a VC and you have invested in a certain startup, and I have not been able to invest in that hot technology and a future thing that somebody's building, I would want to either invest in the next round or invest in a similar kind of a business where somebody else is trying to build a similar kind of a model. That was FOMO. And sometimes the investments by experienced and large VCs were also done without looking at the fundamentals and the logic, what they were doing. It was purely emotional and not rational. So now, as I said some days earlier at another forum, things have changed totally. Not only the funding winter that we saw about 2 years ago drove everybody from the burn obsessed model, that how you scale, whatever way, whatever you need to scale at any cost, or what is a typical burn model, how much runway you have, how much money you can burn so that you can scale, to earn before you burn model. So that has changed the FOMO to a typical GOMO. And what FOMO is a fear of missing out, as I said. GOMO is a new acronym which is coming into the play, which is, first is governance, because if you are going to get listed, the first thing that will come to you is governance, and governance includes compliance and various other small nuances as well. The second one is your operating profit, and the operating leverage that you have. It doesn't matter what rate you grow. Of course you need to grow. Business is a treadmill. You have to continuously run to stand at the same place. Forget going ahead. So growth is a given, but what is the operating profit? And then the M stands for the management quality, because people will look at it. Long-term sustainability will come from the quality of talent that you have. And the last is the operating model. And within that is also your economic moat. Is the model that you follow sustainable in the long run when you'll have a lot of competition coming around? Now, this new thing is something that these startups will soon start getting used to, because this is a fact, and this is the filter, and this is the lens through which all the investors that look at, globally, large investors and even the retail investors globally look at companies that are listed. And I agree with Sidhant that the things have changed. A lot of large investors, a large number of investors have come into the play. There are some different worrying signs as well, because people are picking up loans and taking leverage to trade. That's not a great sign, and they are investing blindly without looking at fundamentals. But I feel that if initial euphoria will settle down, the investors will get mature over a period of time. We are already the 5th largest, the top 5 as far as the economy is concerned, and also as far as our stock market is concerned. So maturity is about to be there. People will see the challenges. The volatility, in the market will drive the maturity.
Right.
But yes, the big shift is going to happen from valuations which were looked at in another manner to becoming more practical and real world.
Right. Thank you, Salilji. Sidhant, what has been your understanding of what Mr. Salil just shared? I mean, he of course has that first-hand experience, but you must have, been talking to people who have had that experience among your fraternity to go into that space. What really changed for them? What have been some of the learnings? And in that context, where would you put Libas's journey as well?
So, when you actually start a new company and as a startup, when you start operating, right, you're looking at so many things at the front end and trying to solve for so many customer facing things that you actually tend to lose track of what's happening at the back end, because that time it's a race, right? ये भी करना है, वो भी करना है, ये भी करना है, ये भी बेचना है, यहाँ भी बेचना है, वहाँ भी बेचना है. So your focus as a startup for the first few years in your growth phase or growth stage is so much on the front end and what's happening. You actually don't look at corporate governance, like you said, right? And you don't look at a lot of other processes, systems, teams, management, etc. So a lot of people who I network with, who I know are in the same network, who've done IPOs recently or some time back. Of course, majority of learnings for us also comes from there, because we are in that phase right now where we are also learning, planning, etc. And when we hear mostly, I think the majority of the changes comes at the back end than the front end, because front end you're still selling the same product, your channels that you're selling it at is the same. What the changes really happen at the back end, where discipline comes into play in terms of corporate governance. You think of things from a very different light. You don't take decisions because as a founder, कोई भी problem आएगी, somebody would walk into the office, I will say, okay, fine, do this, this is the best solve. But now you have to look at that question from a different lens, at how will it be seen, how will it show in my books, how will other people look at it. So for them, they feel that every move, every statement, everything that they do at the back end is somehow being governed, because you're responsible for a lot of people who are actually watching you in your day-to-day activities. So any decision you take, starting from something as small as what goes up on social media, right? People certain things can make or break. As a startup, not like enough people are not watching you. Even if they're watching you, they're looking at from a fan base kind of a point of view and not from an investor lens. So a lot changes. Corporate governance gets improved. You have to make sure that for people to have confidence in investing in you, you have to show them who are the people who are actually working in the company. They care about who's the CFO. They care about what is the background of your certain key managerial positions. So I think what I hear and what most people say is that corporate governance is actually something which is the biggest change at the back end, and discipline is one. Profitability is one. You look at cost in a very different way. You have to make sure that any money that is going waste, you have to be more disciplined around that. So I mean, these are the few things that we feel is majorly the difference between a pre and a post IPO kind of a scenario.
Right, and based on those experience, those learnings, those observations that you shared, where do you see Libas's journey now in that context?
So, like I said, when you actually look at doing that, so it's a process, right? Today, it's not like I can say that we will do IPO and then solve for these things. So, when we have a vision that say in the next 2 years, 3 years, so our vision is that in the next 2 to 3 years we want to do IPO. So, for that we have to start working today, and hence are working towards corporatization, corporate governance, discipline. All those activities have started. We've already started looking at things from a very, very different lens, and I think this journey, I mean, in 2 to 3 years should be enough for us to do that. That we are kind of ready for that situation.
Absolutely. Salilji, very quickly, I would also, just coming back to what you mentioned about the investor euphoria in the market, government really serious about the financialization of the Indian market, the pace that it has been going through. Can you expand a bit more quickly on your understanding of the investor mind frame when it comes to their understanding of the business models that we are seeing when it comes to these recent IPOs, be it on the SME or the main board front? What's your experience on that or reading?
See, the kind of people that you look at who have started going out and investing in the market, you feel good and bad at the same time. Good because you can see everybody. It's not only people who were interested in stock, which was about 10, 15 years ago. Now you see housewives, and with all regards, what I mean is the people who are not working and not interested in business. Those people, that could be house person or a house maker or whoever, who has no interest in business, now getting onto the trading floor. You see early professionals, when I started my career, I wish I was as much involved in the stock market as the youngsters are now, because the power of compounding over the years would have been tremendous. But what you see now, they're doing more trading rather than building up the long-term thing. The understanding of business models is really not there. There's a big problem that we probably will need to solve, because otherwise time will teach in a very harsh manner to all those individuals, and that is why you must have seen the regulator stepping in and saying that please don't give away loans for trading purpose and try to control that part, because otherwise people will start losing money. There's a difference between gambling, trading and investing. Now, if you don't have, if somebody else is doing a day trading, buying in the morning, selling in the evening, and moving into F&O and making some money, and you get, and putting a TikTok reel on top of it, and you get influenced, and you give up your, your job, or you take your mind away from your job, which is your sole money making machine, to getting into this thing, it's risky for the generation. I think there's a big need for the education, the investor education, on what is the right thing to do, what should be done, and of course people should invest, because otherwise the inflation will eat up into your money, your bank FD rate or the savings interest rate is not enough to keep up with the inflation. This is a big area to make your wealth grow. And make passive money grow. But you need to do it in the right manner. You need to understand rather than play in the market.
Right. My screen showing time's up, Salil ji. But very quickly, to conclude this, 2 or 3 points that should be on the essential pre-checklist for startups aiming to go public. Your word of advice for them.
I have met Sidhant for the first time, and I'm very happy that they're looking at IPO for, and with a 2-3 year horizon. That's the first thing. You should not decide to immediately go out and get the bankers in place and start going public, because you need to make a lot of changes. I fully agree with what is being said, that initial part of the journey is just grow, because that is the way to do it. But then later on, you need to get your back office in place, room in place, all the processes in place, and that needs some time. So first is start little early. Second is governance is the big thing. And that is why I said FOMO to GOMO, because governance is the first point, because people will start looking at it. It's very different to answer 4 investors or 4 large VCs sitting in a room in a board meeting, and get on to a call where you will have 150 analysts who don't understand your, with due regards to analysts, please don't take it otherwise, who don't understand your business and will question all the things which you will suddenly find funny and basic, but they will question. So that is a very big change. So second is get the governance in place so that you don't have difficulty in answering the questions. And third is build the talent for long-term sustainability of your model and moat, so that you can keep on growing, not only as a business but also as investors' favorite stock.
Right. Thank you, Salil ji. I agree. Con calls have recently got a bit more hilarious. But Sidhant, 10-15 seconds. Any concluding thoughts?
No, I mean, I think the whole scenario is going to change, and now that I think after the funding winter that we all call it, we've seen that even investors look at businesses from that lens now, right? So the discipline now, even for startups, have started on day one, which was kind of getting lost over the last few years, where so much money was coming in. I mean, now that suddenly liquid markets are not that liquid, so people are seeing that drying up, right? So even, I mean, I've spoken to so many investors over the last 1.5 years, right? And the first biggest ask is that, where are you in terms of profitability? Where are you going to be? And how are you going to go public if you're not profitable, right? So those are the kind of questions, and it's good that people are getting disciplined, because with too much money in the early stage, you tend to lose track of how to grow your business efficiently, because the only way to make money for you is by burning money, which is not a very sustainable case. And 6 months, 1 year later, when that money really dries up, then you don't know how to run a business. So it's very important that in the first early years of your business, if you have that discipline, and then maybe you use certain money to accelerate your proven success, then it makes sense to burn a little bit. But I mean, when you start with that burn, there's no going back, right? So I think that's good that that discipline is coming on day one. So
Thank you, gentlemen, for joining us. Audience, can we please have a big round of applause? And for all the students, I'm sure you have some sort of, insights as to how your investing journey could become, how it should become. So thank you so much.